Have you ever looked at a company's financial report and just wished someone could cut through all the jargon?
Yeah, and just tell you what really matters. What's the actual story?
Exactly. Financial reports, they can be so dense, right? But they aren't just numbers, they definitely tell a narrative.
And today, our mission, really, is to unpack that story.
Uh-huh.
We're looking at the Q1 FY26 unaudited financial results for the India Cements Limited.
That's right. This is our deep dive for you. We've gone through, well, everything we could get our hands on: the official filings, the auditor's reports, the press release, their investor presentation,
We've pulled it all together.
to pull out the most important insights. Our goal is simple: give you a shortcut to being genuinely well-informed about this pretty significant Indian cement company.
Without getting lost in the weeds, hopefully.
Really?
So, yeah, essentially, we're going to explore how this major player in the Indian cement world performed in the quarter ending June 30, 2025.
We'll hit the key numbers, look at any strategic shifts, and, the ongoing developments that really stand out when you dig past just the surface data.
Okay, so where do we start? The headline numbers.
Let's do it. Q1 FY26, the quarter ending June 30, 2025. Consolidated revenue from operations. Ours, 1,024.74 crores.
Okay.
Now, what's interesting is that's almost exactly what it was last year, same quarter ours, 1,026.76 crores. So revenue, pretty much flat.
Right, revenue's flat. But, and this is where it gets really interesting, look at their profit before interest, depreciation, and tax, PBIDT.
The core operational profit measure.
Exactly. In Q1 of FY25, they actually had a loss here.
Yeah.
Minus ours, 9.16 crores
Okay.
this quarter. Q1 FY26, they flipped it completely. The profit of ours, 92.31 crores.
Wow, okay. From a loss to a solid profit, even with flat revenue. That's
It's
quite a
it-
turnaround.
It really is. It's not just numbers. It suggests they've really tackled some core cost issues, some, maybe long-standing inefficiencies. Management's clearly done something significant there.
That's a huge swing. And it keeps going, right? If we look at the profit after tax, PAT, but before exceptional items,
Right, taking out the one-offs for a moment.
yeah, just looking at the regular business, that figure also improved dramatically. It went from a negative RSRO 182.21 crores last year
Big loss.
to a much, much smaller negative this year, minus ours 9.13 crores.
So the operational losses themselves significantly reduced. Real progress there.
Definitely.
However, and this is where we connect it back, despite those operational gains, the final bottom line, the consolidated net profit or loss for the period.
The actual number they report.
Yeah, the final number, it was actually a loss of ours, 132.9 R crores this quarter.
Huh. But last year, same quarter, they reported a profit of 58.47 crores.
Exactly. So this is where those exceptional items come in. One-off financial events that hit the bottom line hard this quarter. We'll need to unpack those.
Okay, so flat revenue, huge operational profit turnaround, but a net loss because of these exceptional items.
Got it.
That's the snapshot. So the obvious question is how? How do they manage that operational turnaround? Let's take that operational deep dive. What happened on the ground?
Well, first off, volume. They actually sold more cement. Domestic sales volume grew by a pretty impressive 11.6% year-on-year.
Okay, 11.6%. How much is that?
That reached 2.18 million tons, MNT, of cement in the quarter. So a solid increase in just the sheer quantity they moved.
Right. But were they just discounting heavily to sell more?
That's always the question.
No.
But no, it seems not. Their cement realizations, that's the net price after logistics costs actually improved.
Oh, interesting.
Yeah, up 5.7% compared to the previous quarter, Q4 FY25. It hit ours, 3,771 per metric ton, up from about ours, 3,568.
So selling more and getting a better price per ton, that's a good sign for their market strength.
It definitely is.
Okay, what about how much of their capacity they were using? The report mentions 61% average capacity utilization. Is that good? Bad? What does 61% tell us?
Yeah, that's a good question. 61% in a heavy industry like cement, well, it's decent. It means they're running at, roughly 2/3 speed.
Okay.
It suggests there's healthy demand. They're certainly busy. But maybe more importantly, it also means they've got room to grow. They can ramp up production if demand picks up further without needing huge immediate investments in new plants. Gives them flexibility.
Makes sense. And this next metric seems to really capture that operational turnaround story. Total EBITDA per metric ton.
Ah, yes.
It jumped to 424 in Q1 FY26. That's a massive leap from just 88 per ton in the previous quarter, Q4 FY25.
Huge improvement. That number really shows the efficiency gains filtering down to each ton they sell.
It really does.
And just to give them a bit more color on how they're selling, their sales mix breakdown is interesting.
Okay.
It's about 55% trade sales versus 45% non-trade.
So more towards dealers and retail than big projects.
Slightly, yeah.
Yeah.
And then 80.6% was bag sales versus 19.4% bulk sales. And 66.4% direct sales versus 33.6% depot sales.
So mostly bagged cement, often sold directly, but still a significant chunk going through depots and to non-trade bulk buyers.
Exactly. It shows they're playing across the board,
Yeah.
targeting smaller buyers through dealers and handling larger project or industrial clients.
Yeah.
A balanced approach.
Right. Okay, so volume's up, prices up, efficiency per ton way up. Now let's get into the cost story, because you said that was key to the PBIDT turnaround.
Absolutely critical. And the first big one is finance costs. Interest payments, basically.
What happened there?
They dropped dramatically to RSV 26.58 crores in Q1 FY26. Compare that to RS 82.36 crores in the same quarter last year.
Wow, that's less than a third. How?
Debt refinancing seems to be the main driver. They managed to restructure their debt, which also brought down their average interest rate by about 110 basis points. That's 1.1% compared to the previous quarter.
Okay.
It settled around 6.83%. That's a lot less money going out the door to lenders. A huge direct boost to the bottom line.
Makes a huge difference. And it wasn't just finance costs, right? Other big operational costs saw improvements too.
That's right. Power and fuel, always a massive expense for cement makers. Those costs per ton actually declined.
By how much?
Down 6% compared to the last quarter, and down 7% compared to last year. Settled at $1,690 per metric ton.
That's significant. And logistics, moving all that cement around.
Also improved. A slight dip, 0.4% versus last quarter, but a much bigger drop, 15% compared to Q1 last year. Came in at $916 per ton.
Okay, so major savings on interest, power, fuel, and logistics. What about people costs? Employee benefits.
Those also saw a notable decrease. Consolidated employee benefits expense went from about RN's 106.5 crores in Q1 last year down to RN's 62.26 crores this quarter.
Another big drop. Were there any costs that were up?
Yes, raw material cost per ton did increase slightly, up 2% from last quarter and 6% from last year to $977 per ton.
Okay, small increase there, but clearly swamped by the savings elsewhere.
Exactly. When you put it all together, you see how that efficient management, especially on finance, power, and fuel costs, really drove that big improvement in PBIDT we talked about earlier.
Right. They've clearly been tightening their belts, optimizing operations, made their core business much leaner.
Definitely looks that way.
So these cost efficiencies are great. They fueled the operational turnaround. But, a company's future isn't just about cutting costs. What about their strategy, their future plans?
Good point. And they're not just sitting back. They've outlined a pretty significant capital expenditure program, CapEx, for the next 2 years.
Okay, investing for the future. What's the focus?
It seems very targeted. Improving efficiency further, reducing operating costs even more, boosting their share of renewable power, and enhancing safety.
So building on the recent gains.
Exactly. These aren't just small tweaks. They sound like foundational investments for long-term competitiveness and sustainability. And they expect the benefits to really start showing up from Q4 of FY27 onwards.
Do they give examples of the kinds of projects?
They do. Things like converting preheaters, upgrading coolers, optimizing processes to cut heat consumption, technical stuff, but it all adds up to better energy efficiency. And crucially, they're investing in 21.8 megawatts of waste heat recovery systems, WHRS, capturing heat generated in the process and turning it into power.
Ah, and that ties into their green energy goals, right? I saw something about that.
A huge ambition there. This is really significant. They want to scale up their green power that's renewables plus WHRS from just 5% in FY25.
Which is now, basically.
But an incredible 86% by FY27.
86%. In 2 years, that's massive.
It is. It involves boosting WHRS from 9 milliW up to 30 milliW and ramping up renewable power from 20 milliW to a huge 221 milliW.
Wow. If they pull that off, that really positions them differently in terms of sustainability in the Indian cement sector.
Absolutely. It's a major commitment.
Okay, what else on the strategic front? Any structural changes?
Yes, a bit of housekeeping, you could say. The board approved amalgamating 4 wholly owned Indian subsidiaries into the main company.
Which ones?
ICL Securities, ICL Financial Services, ICL International, and India Cements Infrastructures, effective Jan 1, 2025.
So consolidating things, aiming for streamlining, synergy.
Presumably. Though, the real impact depends on regulatory approvals, which are still pending.
Right, and did you mention asset sales? Those connect back to the exceptional items that hit the net profit, don't they?
Exactly. This is where those come in. The company approved selling its stake in Industrial Chemicals and Monomers, Ltd, ICML, for about Rs 98 crores.
Okay.
And a subsidiary down the chain approved selling its stake in an Indonesian company, PT Mitra Sedia Tanah Bumbu, MSTB.
So selling off non-core assets, perhaps.
Seems likely. But the key financial impact this quarter came from impairments related to these sales. Basically, writing down the value of these assets on their books as they prepare to sell them.
Ah, so that's the hit.
That's the hit. About Rs 47.5 crores impairment for ICML and Rs 76.2 crores for NSTB. Those are the big exceptional items that drag the net profit down despite the operational improvements. It's an accounting adjustment reflecting the lower expected value from these assets being sold.
Got it. So, cleaning house, taking the hit now. Despite that, what's the company's overall feeling about the future? Their outlook?
They sound pretty optimistic, actually. The official statement says they're poised to grow stronger.
Okay.
They expect more benefits from that CapEx program we discussed, synergies with their holding company, Ultratech Cement, and positive market trends, government spending on infrastructure, better housing demand.
So they see tailwinds despite the current net loss figure.
That seems to be the message.
All right, let's shift gears slightly. Balance sheet health and anything the auditors flagged. Always important to check.
Definitely. So, consolidated debt stood at Rs 12,241 crores at the end of June 2025.
How does that compare?
It's up slightly from March, when it was Rs 1,159 crores. For a company this size, it seems manageable, but, it's a number you'd want to keep an eye on.
Sure. And cash flow?
That was negative for the quarter. Operating cash flow was minus Rs 138 crores, and free cash flow to firm was minus Rs 81 crores.
Negative cash flow isn't ideal.
No, but there's context. Remember those asset sales? They actually received Rs 81 crores in cash from assets held for sale during the quarter.
Ah, so that inflow helped offset some of the operational outflow.
Exactly. It's not unusual to see lumpy cash flows when a company's selling off assets like this.
Okay, makes sense. Now the auditors, did they give a clean opinion? Any warnings?
They gave what's called a clean review opinion. It's a limited review for quarterly results, not a full audit. But they did include an emphasis of matter paragraph.
Okay, emphasis of matter. That means pay attention to this.
Pretty much.
Yeah.
It doesn't change their clean opinion, but it flags specific issues they think are important for users of the financial statements to be aware of. In this case, 2 ongoing legal matters.
Legal issues, okay.
Yeah. And crucially, the company believes it has strong legal grounds not to make any financial provisions for these yet based on legal advice. But the auditors are highlighting them.
What are they, and how much are we talking?
First, there are assets with a book value of about Rs 120 crores that were attached by a statutory authority way back in 2015.
Attached, meaning seized or frozen.
Effectively frozen pending legal resolution. The matter is still sub judice, under court consideration. The company thinks they'll win, but it's been dragging on.
Okay, 120 crores tied up there, potentially. What's the second issue?
A penalty imposed by the Competition Commission of India, the CCI, back in 2016.
Ah, anti-competition ruling.
Seems like it. The penalty was Rs 187.48 crores.
That's substantial.
Very. The company paid 10% of it, about Rs 18.75 crores, as required to appeal. They appealed, and the Supreme Court has admitted the appeal and said the interim stay on the rest of the penalty continues.
So again, they're fighting it, believe they have a strong case, but it's another big potential liability hanging out there.
Exactly. Almost 190 crores.
So what does this emphasis of matter really mean for someone trying to understand the company's health? Like for you, the listener?
Well, it means there are these 2 significant potential liabilities, totaling over Rs 300 crores if you add them up. Yeah. While the company is confident and hasn't booked a loss for them yet, the auditors felt they were significant enough uncertainties to specifically point out. They represent a potential risk down the road if these legal cases don't go the company's way.
It's definitely something to keep on the radar then, a potential future financial impact.
Precisely.
Okay. So if we wrap this up, quite a complex picture for India Cements this quarter.
It really is. We've
Yeah.
sort of navigated through these Q1 FY26 results, and the big takeaway is this story of a significant operational turnaround.
Driven by those cost efficiencies, especially in finance and energy.
Right, and backed by strategic initiatives like the CapEx and that huge green power push. But it's happening alongside these ongoing legal challenges and the financial impact of selling off assets.
Yeah, we've seen a company making real strides, optimizing its core, investing heavily in a greener future, but still dealing with some legacy issues and restructuring.
So I guess looking ahead, the big question is, how will all this play out? How will that bold investment in green energy and efficiency,
Coupled with maybe a strengthening market and hopefully resolving those legal issues.
how will that shape their path forward in what's a very, very competitive Indian cement sector?
Yeah, what potential for real growth and transformation do you see hiding in these numbers, especially with those ambitious sustainability goals? Something to think about.